Streamed. Awesome. Awesome. Just about ready.
Welcome, everyone, to Name Confidential Live.
Hey everyone, thanks for being here. Welcome to Name Confidential. I'm this week's host, Ryan Redford. I'm filling in for Ben Fox today, who is out sick. But lucky me, I get to talk to Henry Rohlfs of Halbert Wealth Management, one of my favorite people in name. So I'm super happy to see you here today. Thanks for being here, Henry.
Oh, you bet, Ryan. I'm really happy to be here with you.
Awesome, awesome. Well, let's dive into the name sentiment index, and I believe you are a contributor. Current number is 86. I know personally I reported 90 this week, so I'm helping bring that number up. Uh,
Ooh,
how
so
about
we
you?
really are helping that number up because we reported 200. We are
Nice.
fully 2x long right now.
We are both doing our part to bring up that average. I appreciate that. No, I think Jan Naismith has a great study on this, showing that anytime the name sentiment indicator is above 80, it's usually a pretty good time to be invested. So it's not a bad indicator for that. So I tend to watch it now. Just is it above 80? Is it not above 80? Because we're name is mostly trend followers. So
Right.
so what's the strategy that you use to report to the name index?
So it's our flagship strategy called Alpha Advantage. It's a blend of several different indicators, and it's been doing really well. Month to date, we're up about 4%, but year to date, we're over 50%. So it's
Whoa.
doing quite well. We're
Killing it.
very pleased.
Killing it. No, that's awesome. That's fantastic. Well, nice job. Nice job. Well, we're doing our part. Name index is holding strong. We're doing much better than the AAII group are because they've been bearish until like last week. I think they completely missed this run. Um,
And
so
it's funny because September is typically not a great month to be in the market.
yeah,
And a lot of people bail out, and they're really missing it this month.
really are. They really are. Yeah. Yeah. I was looking at seasonality and we were talking about that, but the trend is still there. There's no reason to not be invested as much as there's a lot of good reasons not to be, but that's trend is not saying do it. So
Mhm.
not saying to be out. All right, well, let's dive into you, Henry. Let's talk a little bit about you, your background. How did you get into where you are now? How did you get to be this awesome and much of a badass in your strategies? Where did it all start? What's the origin
Well,
story?
I have a sordid past. My degree is actually in biophysics and biochemistry. And so I did a lot of statistical work in the lab. For whatever reason, my dad at the time said, Henry, take as many computer courses as you can. That's the wave of the future. And sure enough, I ended up becoming a programmer, um, and ended up being in IT for quite a few years and was hired by Halbert in '98 to run their IT department. Oh, yeah, by the way, just a quick mention, Halbert Wealth Management is celebrating its 30-year anniversary this year.
Nice.
And so we're really pleased. And I've
Nice.
been there for 25 years of it. So I'm real happy to be with the firm. But yeah, through things, I eventually took over as vice president of operations here at the firm, and I'm just really happy to be here. And we've got a great group of folks, and I really enjoy it.
Nice. So with the programming, has that helped with strategy development or strategy testing?
Strategy testing for sure,
Mhm.
because it's really easy to understand statistical analysis that usually you see in analytical programs like what many of the folks that name support.
Right, right. Well, cool. So based on that, so how let's go to investment philosophy. So you get to test your philosophies, but how did you become an active manager? I mean, many people start very buy and hold, proper
Right,
allocations and that. So how did you get to this point from that? I feel like we all started down there.
right. So 30 years ago, Mike Posey, many people will remember him. He had joined the firm and got involved with NAIM when it was still called Safety. And we became very interested in active management because there were so many of our clients that we talked to who said, we thought because they were sophisticated investors and many of them were accredited or better, that probably their stock timing was quite good. And from talking with them, they said, oh goodness, no, we tend to buy at the high and sell at the low, just like everybody else. And so we looked for ways that we could support our clients with something that would give them an advantage in the market. And that's when we started looking at active managers. And over the years, have used quite a few of them. And that's we've been involved with NAAIM ever since then.
So do you have your own strategies, or you use outsource, or do you a blend? How do you get to that point?
They're a blend of strategies. At this point, we found that single strategies, we weren't quite as happy with those, and so we've been using blended strategies.
Right, right. And I've certainly found that the best diversification is actually diversified by strategy, not by asset class. Makes so much more sense
Sure. Yeah.
for creating a good equity curve. So that's awesome. So are there any philosophies that guide your strategies, or any kind of go-to metrics that are you like trend, you like momentum, you like reversion? What's kind of your take on
Well,
strategy?
we're a little bit different here.
Okay.
We started out, the firm actually started out 40 years ago. Our founder, Gary Halbert, started some of the earliest commodity pools.
Oh yeah.
And so he came from the commodities business. And we found that a lot of our commodities clients were accredited or better. And so we started looking for ways that we could help them to build legacy wealth. And Ryan, if I can I share a screen with you?
Absolutely, absolutely. Yeah, yeah. That's even more
So
fun.
this is where we have settled with our business, and that's it. We want to create legacy wealth for our clients by investing like an institution.
Mhm.
And I'm just going to flip through a few slides here
Love it.
quickly. Um,
You're not sharing it though.
oh, I'm not sharing.
No.
Oh, let me try again there.
All right.
There we go.
There you
Okay.
go. There you go.
So yeah, this is what we found. We looked
Okay.
at a bunch of different um, large investors, typically endowments for universities, and asked the question, how do they invest? And what we found was they used diversified portfolios. I mean, that's pretty normal investing, but they were designed to limit losses. And that was one of the things that we were very attracted to. Lower exposure to fixed income, and strangely enough, about half in alternative investments.
Hmm.
And so we asked the question, what are those percentages? And this is what we found. And these are real
Oh
statistics
yeah.
from these universities. And you can see that as compared to the traditional 60-40, the mixes are very different. But the thing we found that was really interesting was they were invested a lot in private equity and absolute returns, which is typically your actively managed funds. And in fact, one of the interesting things to us was Yale's philosophy actually states that their allocations stem from their return potential and diversifying power. And what they found was that these portfolios have significantly higher expected returns and lower volatility. So that was something that we really wanted to try to emulate. And this is what we look for in our alternatives. We want a low correlation to stocks and bonds, lower volatility over time, and consistent absolute returns. So that's really where our firm lies, is that we are not strictly an active management shop, but instead we look to try to build that legacy wealth just like an institution does.
Love that. Love that. Because yeah, when I've studied those a little bit myself, yeah, it's all about the drawdowns. That's really the to make money
Sure.
last. You can't have the big drawdowns.
In
You
fact,
are
that's the crazy thing for us is with our alpha advantage strategy.
Mhm.
That was the thing that we really tried to do, was to limit those losses. That was our number one goal.
Yeah,
And it just so happened that we stumbled into better returns as well.
fantastic. Well, I think over time, if you really can do a good job of muting the losses or the downside, it takes care of itself. And a lot of people don't realize that. A lot of times you don't even have to outperform on the upside if you do really well on the downside.
Oh,
It
exactly.
it all just kind of works out, and it surprises a lot of people because you always get the, well, did I beat the S&P? It's like, over what time frame?
Uh,
Was it down 20%? You were down 15? Yeah, you beat the S&P, but does that matter? Big picture, does that create legacy wealth? It doesn't. It's not this. That's not how it works.
and that's the other struggle that you always have with clients, and that's to keep them from just looking at the short term, but instead look at long time frames, because that's when our strategies work best.
Absolutely, absolutely. Do you come at it from like a standard deviation? Like what kind of metrics are you measuring when you're looking at your
The
downside?
biggest one, and I think this probably comes from the commodities industry, is max drawdown. And
Okay.
that's where we really typically focus on, and have trained our clients to look at as far as strategies go.
Okay.
But of course, things like standard deviation, just to
Yeah.
see how volatile things are, that's really important. Um, and other metrics that really have to do with losses. That's we look at those as well.
No, for sure, for sure. No, it's interesting. A lot of people come at it. I think it's interesting in the name community that we're all kind of thinking that way, but everybody comes at it a little bit differently. So it's fun to kind of
Yeah,
compare and contrast and go, well, I think about it this way. Well, I think about it this way. We kind of both end up at the same place, but coming at it from completely different places. So it's a neat thing about name in the community is getting to talk to people who we're all going for the same goal, but we just come at it so differently.
and it's really fun to talk to some really smart people.
Yes. Like it, like this guy today here, this Henry guy.
Oh,
So well, nice. I think you also were going to talk about when Ben was the host. You're going to talk about, are we heading into recession? I think you had some really good insights on that. So do you want to
yeah.
dive
So
into that?
that was something when Ben and I talked earlier about today. He said, if you have any views on the economy, what the outlook is, short term, long term. And I got to thinking about it. And one of the questions that, of course, we're asked all the time is, are we headed into a recession? And I'm going to share another screen here. There we go. Are we headed into a recession? So, what I did was try to look at a few graphs, first of all, that talk about where we're at with the economy. Just today, the new PCE index, the Personal Consumption Expenditures Index, came out, and it increased slightly from 2.6 to 2.7% annualized. Not bad. So inflation is not quite to the Fed's goal of 2%, but it's holding reasonably steady. And I think that the Fed is reasonably happy with that. Now, to contrast, personal savings are down some. That's that black line that you see on this graph. It's slightly down. But the crazy part is actually incomes are up and rising slightly. And to go right along with that, I think most people, when they get a little extra income, tend to spend it right away. So we're
Mhm.
seeing that disposable income spending is also rising. Those are the orange bars that you see. And remember that consumer spending goes to about 70% of total US GDP. So that's a good sign for the economy. Um, in the news, we hear a lot about the Consumer Confidence Index, and I still hear regularly that consumer confidence is down. But if you look at the numbers, and this is from the conference board, you can see towards the end there that actually consumer confidence has gone up since the first of the year. It's bouncing around a little bit. We're not quite over the 100 mark. If we get over 100, that's a really good sign that shows that confidence is up, but we're not doing too badly. Of course, the next thing to look at is jobs. And I think this is where the Fed is really focusing at this point. In fact, Jay Powell said at a conference just after a news conference, just after the release of the last the last index, or I'm sorry, the last percentage, that they felt that that was their main focus at this point, but that going forward, things were. Let's see, I'm trying to find the quote here. and I'm not finding it, but that it was going to be a difficult task going forward because of this dual inflation versus jobs. But as you can see from this chart, the black line on the top is the number of open jobs, and that's getting really close to that bottom green and blue, which are the numbers of unemployed people. So those two numbers are starting to match pretty closely. So I think the Fed is really starting to look at trying to juice the economy a little bit, not too much so that they don't mess with inflation, but to start to encourage businesses to spend. So the right now the unemployment numbers, it's a recessionary trend, but I think that what the Fed is trying to do is to keep those numbers from going too low. Now, one of the indicators of recessions that I really like is called the SOM rule. And it was created by Claudia Sahm when she was an analyst for the Federal Reserve Bank. It is really interesting. It indicates the start of a recession when the 3-month moving average of the national unemployment rate rises by about 0.5% or more relative to the minimum of the 3-month averages from the previous 12 months. So it's really trend following when it comes to unemployment. But what you can see here is all the gray areas are recessions. And the SOM rule, which is what I just mentioned, will start to rise considerably at the beginning of those recessionary periods. And it's pretty consistent. It's been pretty good over the last 50, 60 years. But right now, the SOM indicator is trending lower. So it is not showing a recession. In fact, I heard an interview last week from Claudia Sahm, and she reinforced that she does not believe we're headed into recession at this time. But what about other recession indicators? I wanted to find some that are off the beaten path. And one of them is the lipstick indicator, that if women are not buying lipstick as much, then the sales are falling. Then what happens is it's an indicator of a possible recession. The other one is the underwear indicator. And from what I understand, Alan Greenspan liked to use the underwear indicator as a recessionary indicator. But right now, the underwear indicator is showing that we're headed towards recession. But the lipstick indicator is not. Now, of course, the lipstick indicator might be jaded a little bit because women, if they have to hold back on spending, might buy a cheaper brand of lipstick rather than a more expensive one. So we don't have 100% good data on that. But what was interesting to me was I had lunch earlier this week with a friend of mine who told me that his University of Kansas professor of finance had another recession indicator that I thought was really interesting. And it's called the Invisalign indicator. And it shows a tendency for people with disposable income in a recession will not buy Invisalign. Now, it took some real digging, but I found some data on the Invisalign sales. Now, here at the beginning, whoops, I'll go backwards here. Yep. There we go. So at the beginning here, it shows that we are still trending upward in Invisalign sales. So the Invisalign indicator is showing that still we're not in a recession. But if you look towards the end of the decade, it's showing that sales might flatten. That's the projected. So they're thinking that a recession might be coming up later in the decade. Now, does that mean that we know whether it's recessionary or if we're going to have the soft landing people talk about? We just don't know. Come back to me in 6 months. We might have a better answer.
Nice. Wow. That was a whole bunch of stuff. Yeah. I mean, I'm not one that fears recession. I think cycles have to happen. And I think the more that we don't do it, I almost wonder if it makes us worse off in the long term. We should have a little bout of, pullback, and then we can continue.
Right. And we know that a pullback is going to happen sometime or another. I mean, we saw one in 2022, and that one surprised a lot of people, but then it bounced back up. Is it going to continue to be like that? We don't know. It's really hard to tell.
Yeah, and these
Buckle up.
20 yeah, and these 20% drops. I mean, we had one this year, basically. Well, 19, but I mean close enough.
Right.
It used to be like every was it 5 or 10 years you get a 20% drop. Now it's every two, every other year. We're actually seeing it that frequently now. I think it's fascinating. But maybe just information moves that fast. I don't know. Or maybe it's the algos.
Right. And that might be it.
Mhm.
Social
Nice.
media market moves.
Yeah, yeah. So are you in the camp of you think there's gonna be two more rate cuts this year based on the data here?
I know for sure there's going to be one more.
Mhm.
The second one, I don't know. That's really hard to tell. I want to see one more employment release at the end of September, and I think that, or I'm sorry, at the end of October, and I think that'll give us a better idea of what it looks like. Um, I looked at the Fed dot chart, which I almost put up, and it shows a second rate cut. Man, it was all over the place. It
Yeah.
was really a 50-50 coin flip.
Interesting. Interesting. Yeah, I'm curious about the unemployment. It's unemployment, it didn't you couldn't tell from your line, but it is trending up, but it's really slow. Really
Yeah,
slow. And if that ever like starts to accelerate, then I'll wonder if something else is up. And I'm kind of personally watching that metric as well. But for now it's
yeah.
just like But what happened? You think look at back to 07, 08. It was like very slow grind and then just boom, it took off and then the problems were much more apparent. Um, a lot of people are also saying that if we get these rate cuts, that we'll probably see more inflation. I'm kind of curious if you have a take on that.
Well, and that is part of the problem. I think that with this much spending, the question to ask is whether it's because people have more disposable income, period, or if they're spending more because of inflationary tendencies. We're just now starting to see tariffs affect the economy. Whether those tariffs are going to stay in effect, that's another question that we just don't know. We all let's see, what are people calling it, the tariff trant.
Yeah,
We
tariff
all
tantrum.
lived through that, and yeah, we'll see what happens. It's we're in such an unpredictable moment right now. It's pretty much wait and see what happens the rest of the year.
For sure, for sure. Well, I mean, the amount of fear that was put out about the tariffs, earlier this year was like, oh, it's going to be catastrophic. We're all going to die and whatever. And then it's like it hasn't been as bad as I think many
Right.
have thought. I think that's surprising. And then maybe that's driving this good market this year.
But it is still affecting certain sectors, and we're going to see
Absolutely.
that.
Yeah.
I think in heavy equipment, that's going
Mhm.
to be an area that's really going to be hit. So how that's going to affect GDP,
Yeah.
it's uncertain, but it's got to have some effect.
Right. Right. So okay, let's say if we get a recession, what would you be thinking to do to be defensive? Like, how would you come at it?
Um, for me personally,
Sure.
so one of the things that we look to invest in um, are things that are going to long term hold their value. And I don't think much about we don't do gold investing, we don't
Mhm.
do art investing, but private credit it
Okay.
seems like it's going to be a continue to be a good area. We've had some really good success with our private credit managers.
Mhm.
The other area that we're looking at, which is going to be really interesting, is real estate,
Yeah.
because real estate values have dropped
Mhm.
considerably. The big question is, are they going to keep going down?
Yeah.
We don't know at this point, but some of our managers are beginning to position themselves in sectors that they believe are going to still be strong. One of which is new construction starts for single family homes or multiple family homes.
Mhm.
That area still seems to be pretty strong.
Interesting. I've also seen people like the self-storage space for recessionary
Yeah,
times
yeah,
as a popular one. As far as the credit, what do the private credits invest in that you're seeing? I just see a lot of them in the real estate space. So I'm always curious if that's going to be able to keep the yields they've had if we get a recessionary period.
sure. So just think of it as a private bank.
Mhm.
Banks have really tightened up on their money supply that they're lending, and so this is the secondary market.
Okay.
And if here's the thing for me. I watch the NASDAQ quite a bit for that because there are a lot of tech firms, and that's where a lot of secondary market lending happens, is in the tech sector. So if that continues to be strong, that means that tech companies are spending money, and if they're spending money, they need to borrow money. Of course, the rate drops really make that secondary market happy because it's easier to get cash. So,
Okay,
that's where we're watching right now.
fair, yeah. But you said the if the banks are getting a little bit more tight with their wallets, I mean that's usually a I don't say recessionary, but that's kind of a heads up that something isn't quite going right.
Well, they're still operating under Dodd-Frank, and so because of that, they aren't able to have as much cash on or as much cash to lend on hand. I'll put it that way.
Right, right. Well, nice, good wisdom there. Well, I know we're kind of getting close to the end, so I've got to ask you: do you have a favorite investment quote?
That's like asking me what's my favorite food. It
All
changes
food is good.
yeah, it changes all the time. But I did see one earlier this week from Warren Buffett, and that is, we don't have to be smarter than the rest. We have to be more disciplined than the
Nice.
rest. And I think that that speaks quite well of a lot of the managers who are in name,
Yeah,
because they are very disciplined investors. And I appreciate that.
nice. And then, of course, we got the Name Outlook Conference coming up November 3rd and 4th in Chicago, Illinois. I believe you're not going to be there, but I think you have a good reason.
I'm not going to be there. About every third year, that conference falls right on my wife's birthday, and she is having a landmark birthday, shall we say.
Yeah,
So I have to stay home, but I'm going to miss you guys, and we'll catch you in the spring.
absolutely. I don't want you to get in trouble for that. And actually can kind of relate to that. My anniversary is usually on the spring conference dates. So luckily my wife is in the business and I can bring her along. So it
Right.
works out. It works out. But that's a great conference. I really like that. Yeah, sorry I won't see you, but it's always good to see you in person. It's definitely a good conversation.
Ryan, it's such a pleasure to be with you, and it's been too long. We'll have to get together soon.
We absolutely should. Yeah, you're like 10 minutes from me down the road. I don't know how why we don't get lunch more often. It's kind of funny, but I know it's life gets busy. But yeah, I guess that's it for today. Thanks for being here, Henry. Good to see you again, and we'll see everybody next week on Name Confidential. All right, bye everybody.